If there's a dividend tax credit, which we'll talk about later, that's added in. That final result then, the 2570/70. Oh, missing a zero. 2570/70. Isn't there? So 6750 minus 2570/70. So remember, the 6750, that is the tax we calculated earlier on 65,000 in taxable income. So assuming someone had 65,000 in taxable income, they would have raw tax of 6750. Remember, that came from line 81 above. Yep. So 6750 minus 2570/70 leaves us with how much? 4179.30. Excellent. And that is this person's basic federal tax. All right, we're not done with this person's tax by any means, but that is the heart of the calculation. So you can see how it works. You can think of tax credits as canceling out the tax on someone's first X amount of income in the year, because they, by and large, cancel out tax at a rate of 15%. Okay, so mechanically, that's how it all works. And we're going to be coming back to it again and again, but key to it is understanding that tax credits are only brought in after we arrive at a final figure for taxable income. And I just find it easier to walk you through the form rather than simply speak from the slides. So just needs a moment to get it up. There we go. So, because as we can see, though, when we blow up Part A of the form, it is representing the federal tax brackets one at a time. So if you are doing tax for a different year, or as we'll see later on, if you're looking at provincial taxes, this form gives you a really quick, a way to really quickly tell what are the tax brackets in a given year, in a given situation. And if you look at a form from a different tax year, you can quickly see what the tax brackets are that apply in that given year. Similarly, Part B is where we calculate all, it's spread over 2 pages, but it is all the various tax credits which are going to apply in a straightforward way to the return. So now that we know that, then we can speak a little bit more about other tax credits other than CPP. So the first one I'm going to touch on is employment insurance. And this is specifically one which applies only to people with employment income. Now, EI is similar to CPP in that it is mandatory and it is a federal deduction, but it is simpler than CPP because there is no exemption. The maximum EI insurable earnings also only has one tier. There is no EI2. So your maximum insurable earnings are $63,200, which is to say that if you make more than that in a year, you are not covered for EI on the amount above that. The employee premium rate is 1.66%, and so 1.66% of $63,200 is $1,049.21. So it's a more straightforward calculation because there is no basic exemption. You are assessed EI based on your first dollar of employment income, and there is no second tier. Box 18 is the EI premiums that are deducted in the year. Box 24 is the insurable earnings for the year, up to a maximum of $63,200. And box 28 is the EI exemption. And again, we click X if someone is exempt. Now, notice this applies outside Quebec. I'll explain that a bit more in a moment. So first of all, touching on EI premiums. If someone overpays EI premiums, and this is less likely because someone will typically only have an EI overpayment because, again, there's no exempt amount, there's no proration conditions which apply. You're either earning employment income or you're not. So your overpayment will usually only result either through a payroll error or if you have more than one job, because again, the maximum $63,500 only applies 200. Yeah, 63,200 only applies per year, not per job. Now, so any overpayment is calculated on this form called a T2204. Divya, I'll speak to that as well. So EI is for employment insurance, employment insurance premiums. So any overpayment is calculated on this, the T2204. And as you can see, it has the rate for residents other than Quebec. So outside Quebec, the EI rate is 1.66. In Quebec, it is 1.32. The EI rate is a little different from CPP because it fluctuates more from year to year. Again, if we were to look at the CRA page for CPP contribution rates, we could also look at the historical premium rates for EI, federal and Quebec. And you can see that with EI, the rates fluctuate up and down, broadly speaking, in relation to how much unemployment was a problem in a given year. So you can see that back in the 90s, the EI contribution rate was more over 2%. Since about 2004, it's been less than 2%, and it's kind of fluctuated up and down, although it's been relatively stable since 2017. In Quebec, it is a little different, and in general, a little bit lower, although it also fluctuates. And the reason for this is that in Quebec, EI is essentially split into two programs, one of which corresponds to so essentially, the federal employment insurance program applies when you lose your job through no fault of your own, but it also applies in certain situations such as parental leave or similar situations where you haven't lost the job, you're just stepping away from the job temporarily. In Quebec, parental leave is its own separate program. So in Quebec, essentially, the EI contribution is split into two, and so the EI boxes on the tax return in Quebec only correspond to that portion of the program. The rest of it, the rest of the contribution is in a separate box for Quebec residents only. So either way, whether you're a resident of Quebec or not, the required EI premium is reported on line 31200 of the income tax return, and it is a non-refundable tax credit. So again, there is no enhanced contribution, there is no deduction associated with it. If applicable, any EI overpayment is a refundable tax credit, and again, that's calculated on form P2204 and transferred to line 45000 of the income tax and benefit return. All right. So let's see how well you've absorbed all of that. And tell me in the chat. So for taxpayer who has $44,000 in insurable earnings, as noted in box 24 of the T4. What is the required EI premium? Okay, good. Right, so remember, excellent. So remember, there's no exemption here. So you are simply calculating a simple percentage of the 44,000. And for 2024, that is $730.40. That is $44,000 times 1.66%. And now let's walk through a simple situation. So bearing in mind, let's take this information forward. So we know this taxpayer has $44,000 in insurable earnings, as noted in box 24 of the T4. The EI premiums withheld on box 18 shows $748.20, but we know the required EI premium, because we just calculated it, is $730.40. So, first of all, is this an overpayment or an underpayment? Good. Correct. This is an overpayment. All right. So, first of all, what amount goes on line 31200? Remember, 31200 is the non-refundable tax credit. So this is going to be the required premium only, not the amount they actually paid, only the required premium, $730.40. The amount over $730.40, they're not required to pay. So that is an overpayment. So what line does the overpayment go on? Good. It's going to go on line 45000. Excellent. And what are we going to put on line 45000? Good. $17.80. And remember, it's 80 cents. So 17.8. Try to get out of that habit, because it is 80 cents, not 0.8. Remember, we're always dealing with dollar amounts. So we never say $17.8. We say $17.80. All right, good. So, non-refundable tax credits versus refundable tax credits. What is the difference here? So a non-refundable tax credit, as we just saw, is located in step 5 of the tax return. So your basic CPP EI contributions, these are located in step 5 of the tax return. These reduce your taxes payable. They can reduce your taxes payable down to 0, but they cannot create a refund. Refundable tax credits, by contrast, are brought in step 6 of the tax return, or they are paid separately from the tax return, and they reduce total payable, which reduces balance owing and can create or increase a refund. And I will be sure to show you that in the diagram once I cover the other things. So, well, no, I can do it here. So, well, I'll do it in a moment, actually. So if you're unclear about any of that, don't worry, I'm going to walk you through that as well. But first, let's look at a few other examples of non-refundable tax credits. So the first one is the Canada Employment Amount. This was brought in the mid-2000s. And this is only for people with employment income. So it is based on your income on lines 10100 and 10400 only. So that is employment income and other employment income. If you do not have employment income or other employment income, you cannot qualify for this. The credit you can claim is either $1,433. This has been indexed for inflation, so it's gone up over the years, or your total employment income if it's less than that. So if you only had $500 in odd jobs, you would be able to claim the $500 as credit, but that's all. We can think of this as canceling out your first $1,433 of employment income early, only. And if we're explaining it to clients, we say this is just for employment income as opposed to business income or pension income or investment income or what have you. So it's intended to be a small incentive in order to work. And Jia has a question. It depends on the credit, Jia. So Jia is asking if non-refundable credits, if there are excess credits, can they be carried over to future years? It depends on the credit. We'll discuss that more in a little bit. But for the Canada Employment Amount specifically, it has to be used in the current year. It's only based on your employment income in the current year. Now, there are two credits collectively referred to as the emergency volunteer credits. And you can claim one or the other, but not both. So first one is the volunteer firefighter amount, or VFA. To claim this, you need to be working as a volunteer firefighter, and you need a certificate confirming that you've worked for 200 hours as a volunteer. If you claim this, you get a $6,000 non-refundable credit on line 31220. When this credit is claimed, if this person has an honorarium in box 87 on the T4, remember we mentioned that in our last session, this can be an honorarium of up to $1,000, which does not need to be included in income. If, however, you are claiming the volunteer credit of $6,000, then you need to include box 87 in income. If you're not claiming this, any amount in box 87 is not included in income. It is reported on line 10105. Unlike wage loss replacement benefits, box 87 is not included in box 14 by default. All right, so normally, obviously, a $6,000 credit will be worth more than a $1,000 exemption. Do bear in mind, though, there are situations in which you may not, a firefighter might not qualify for one or the other. So a firefighter with less than 200 hours will not qualify for this credit. A firefighter may also not receive an honorarium, in which case they can just go ahead and claim the credit. I've only dealt with one or two volunteer firefighters, and in each case they were not receiving an honorarium. So it was a simple matter of just confirming that they had a certificate, and then they could just go ahead and claim the credit. Now, the other emergency volunteer credit is the search and rescue volunteers amount, which follows very similar rules. Again, they need a certificate confirming 200 volunteer hours, and again, they can claim a $6,000 credit. If you claim the credit, you have to declare any honorarium as income, and it is not exempt. If you don't claim the credit, you can simply leave that income off as exempt. Now, important thing to note for the emergency volunteer credits, you can only claim one, even if you're eligible for both. You can combine your hours. So if you had 100 volunteer hours as a firefighter and 100 volunteer hours as a search and rescue volunteer, you can combine them to claim one credit or the other, but you cannot claim both. And again, normally it's going to be more advantageous to claim the volunteer credit rather than simply leaving the honorarium out of income. Now, another employment-related tax credit is the eligible educator school supply tax credit. This is a refundable tax credit calculated in step 6 of the tax return. This one requires certification as an eligible educator, and you can claim it for up to $1,000 of expenses. Now, definitions of all this, these are in the textbook. So I think we can have a look at those, and then we can have a look at step 6 in return. But the basic idea is that this is for teachers, not university instructors, but high school teachers, elementary school teachers, even preschool, daycare teachers who pay out of their own pocket for supplies to use in the classroom. So they get 25% of that back as a refundable tax credit. So let's look at the textbook just to illustrate this. So if we go to the textbook here, which I have open in Edge, and we go to chapter 3. Here, and as you can see, more detail is applied here. Now, the credit was brought in 2016 and was increased to 25% in 2021. So eligible educators are defined here. And again, only elementary, secondary schools or certain early childhood educators. Proof is needed. Specific requirements vary from province to province. Now, for the expenses you can claim, it's a little different from other things in tax where we claim expenses. Normally, when we talk about employment expenses or business expenses, say, durable goods are claimed in a different way than consumable goods. So consumable supplies, the example I always like to give is a box of pencils. You buy a box of pencils, at the end of the year, you've used up all the pencils, you have no more pencils. But some durable goods you buy, and they will usually outlast a year. So things like books, computers, and so on. In the classroom environment, certain durable goods can be treated the same as consumable supplies. But the law specifies what you can claim: books, games and puzzles, containers, and so on. Not cell phones, for example. And in order to qualify, the supplies need to meet certain conditions. They have to be bought, purpose bought for use in teaching, so you can't just bring in your stuff from home. They need to be directly used or consumed at the school or workplace, and they need to be personally paid for by the employee. The school cannot pay for them. They cannot reimburse you for them unless that's included in your income. And the school needs to sign a statement saying that, yes, these are supplies the person purchased, and yes, we didn't pay them for them. And they also need to be claimed in the year that they were purchased, which might be different from the year in which they were used. So if you make a big purchase in December, and use them the next year, you can normally claim them. And then we have some examples here. So, for example, books would be a durable supply. Construction paper would be a consumable supply. So certain electronic devices can be claimed, but again, you can't just claim your cell phone. Now, what this is here is, in some cases, people might be claiming supplies as employment expenses, which are out of scope for this course. Bear in mind that in practice, a teacher can either claim the employment expenses deduction or this credit, but not both. So let's look at an example here. So Ernest is a second grade teacher and spent $1,200 in teaching supplies for use in the upcoming school year. And he wasn't reimbursed by the school, and he used some of the supplies in 2024 and the rest in 2025. So note here, So $1,000 is entered on Part 6 of the tax return. 25% of that can be claimed, so he gets a credit of $250. The remaining $200 is lost. Now, this is an important point to bear in mind. This person had discretion. So if instead they had only spent $1,000, in 2024 and made that additional $200 purchase in 2025, then those additional $200 in supplies could be claimed on the following tax year. So this is not something which can be done when the tax is prepared, but if the person plans their purchases out carefully, they can do $1,000 per year, and then any additional ones they can just claim after New Year's, and so they will be able to take advantage of this. That is the kind of subtlety that taxpayers are often unaware of. So, the one other thing I want to mention is when we say supplies here, normally elsewhere in tax law, supply
Hello, Brian. Do you hear us? We don't hear you. Hello, Brian. I think you're putting up a poll. We don't hear your voice at all, actually, for the last couple of minutes. I see you're putting a poll up, but no one's hearing you.
Sorry, there we go. Sorry about that. The computer restarted, but I think we were able to jump back in. I think I was able to jump back in here before things went too much sideways. Okay, can you hear me okay?
Yes, your voice is back.
Yeah, good. Voice is back. Are you seeing my desktop? Yeah, let's get you the host again. This is one of the reasons. This is one of the reasons that the moderator is the host, so that if something happens to me, it doesn't close out the session. All right, there we are. Okay, good. Yeah, no, my computer actually restarted there for mysterious reasons. So, yes, I don't want to renew antivirus at this time. No, I do not. Thank you. All right. All right. So sorry, I was interrupted in the middle of talking about the refundable tax credits. So was that, and the consumable supplies there. So what I was just saying is that supplies, elsewhere in tax law, supplies only refers to consumable goods. There's a special exemption here, a special exception here for eligible educators where things like electronic devices and books can be claimed in a similar way to consumable supplies. All right. Okay, so let me show you step 6 of the tax return and why a refundable tax credit is different from refundable ones. So carrying forward our previous example, someone with basic federal tax of say $41.79, that would have carried down here to net federal tax on line 42000. So in this case, $41.79. 30, and then that carries forward into step 6. Now, tax credits, non-refundable tax credits, cannot go beyond this point. They can reduce net federal tax to 0, but they have no effect beyond that. And that's important because certain things that you owe come in at this point. So, in particular, provincial tax comes in on line 42800. So federal non-refundable tax credits, logically enough, cannot reduce your provincial tax. So it's entirely possible to have an amount of 0 here for federal tax, but an amount owing here for total payable. So that's why we refer to total payable. So let's assume this person has 0 provincial tax and instead has $41.79.30 is the total payable. That would carry forward to step 6, which is the final page of the tax return. In this stage is where we have refundable tax credits. In particular, tax that's already been deducted and shows up on the T4. So let's assume we had a case where someone had already had the correct amount taken off by the employer, $41.79.30, right? Then any amounts over and above that would, wow, I don't know why the font is so small. PDFs. But notice, so any CPP overpayment comes in here. Any EI overpayment comes in here. And the eligible educator school supply tax credit comes in here. So, given that example we just saw, if someone had $1,000 in school supplies, they could claim that would give them school supply tax credit of $250. And so that would give us $41.79.30 plus $250. So $41.79.30 plus $250. How much is that? No. 41.79.30 plus 250. Good. 44. So 44.29.30. And that comes over to line 171. So the 41.79.30 minus the 44.29.30 gives us minus $250. And if it's a negative amount, it goes to a refund on line 48400. So in this case, a refund of $250. hence refundable tax credit. Okay? So that's the basics of how it all works mechanically. And I just like to show you guys on the form itself because it makes it a little easier often for people to understand than just say giving you the line numbers. So it's 12:53. So we'll do one more poll question, just to make sure everyone's feeling comfortable with it. And polling, thank you. All right, so let's open up the old poll. So for someone who's in the third tax bracket, and they have union dues of $1,433 and Canada employment amount of $1,433, which of these two things gives them greater tax savings? Now, this might seem academic, but sometimes there will be a case where someone has the option of claiming a deduction or a credit, or maybe the deduction they can claim in this year or a different year, or maybe the credit they can claim in this year or a different year. And they want to know which one's going to be more beneficial. That's what this kind of question is important. Okay, so kind of got an even split of the answers, and a certain number of people didn't get a chance to answer the question or a little bit unclear. So, important to remember, union dues are a deduction. So, union dues, therefore, reduce your taxable income. And any dollar which is not included in your taxable income doesn't go through that tax bracket diagram we saw earlier. So in other words, it saves you tax at that top marginal rate, which is if someone is in the third tax bracket, right, they're paying 26% tax on that $1,433. So this person would want to claim the union dues so that they're not paying 26% tax on $1,433. The Canada employment amount is a tax credit, so it only cancels out tax at 15%. So it only cancels out tax in your first tax bracket. So the union dues then have a greater tax savings than the Canada employment amount because the union dues are a deduction and the Canada employment amount is a non-refundable tax credit.
I just want to jump in. It's just a technical issue since Brian had to restart his session.
Yes, it looks like I missed a question there. Yeah. Is there any other questions?
No, the question is that people sending messages in the chat, they're all going to the host privately. So I just want to remind people, choose to send to all participants because it's probably reversed.
I may need to one second.
Is that true?
Yeah. No, it's a WebExism. Hang on, I'm going to need to stop sharing for a second. Don't worry. Thanks, Charles. The short version of that is when I just lose power for a moment, like if my screen goes into screensaver mode, I may lose connection and rejoin, and it doesn't disrupt the settings of the chat. But when I have to, when I'm kicked out entirely and have to re-come in, there's some participant settings I have to reset. All right, it should be fine now. Okay, all right. So, yeah, normally when I'm trying to get back in after getting kicked out, I have to kind of scramble to get back in, so I often forget to reset the participant privileges. So that should be fine now. Phew, all right.
All right.
Yeah, so then, any questions? So are there any questions? Any questions?
Yeah, you didn't miss any
that I haven't.
You didn't miss any during that. There was just answering some numbers, but no major.
Okay, good. So if no one has any questions about all that, then we're not quite to 1 o'clock yet, but we're getting there. What time is it? Oh, it is 1 o'clock. Well, that's not a bad time to have a break for questions. So we're not going to stop recording just yet. So Charles, what I'm going to propose then, if you guys haven't already, have a look at chapter review problem 3-1 and 3-2, and then when we come back from lunch at 2 o'clock, then we'll go over those before we dive into things. All right, just so we're not too rushed for time. So again, the chapter review problems you could find at the end of chapter 3. So if you haven't already done them, at least have a look at them. Now, escape key. Escape, thank you. For our next session, which will be after lunch for us, there's going to be some other things I want you to do first. So let's swap those slides. All right, so there we go. So for after lunch, then, we are going to go over the results from self-test number 1. So if you haven't done self-test number 1 already, prioritize that, and then we will look at that after lunch. The self-test is not for marks. It is for more for practice. It's to give us an opportunity to see where everyone is at and if they understand everything clearly. And it helps me see if there are things that I need to spend more time on, and so forth. So if you self-test number 1 comes after chapter 3 in the textbook, but before chapter 4. So do your self-test number 1 and the chapter review problems for chapter 3 if you haven't already. Then after lunch, we will look at the ink doc for chapter 4 and chapter review problem 4-1. We're going to review the answers for this test after lunch, so I would suggest doing them over lunch. Otherwise, you can try to answer them as we go through, which is possible. This is not a test for marks. This is more of a homework exercise, and it's not that time consuming. So have a look at it. At the beginning, after lunch, if you want to have a little time to work on it, I'm not a monster. I'm happy to help you with that. But yes, bear in mind for most people taking this course that the course is every couple of days or so they would have a couple of days between sessions. So in our case, because we're doing both sessions on the same day, accommodations need to be made. All right, but yes, the self-test is a homework exercise. All right. good. So on that note, because it is 1 o'clock, let us that last 20 minutes went real fast. All right, so let us break. It's 1:03, so just to give you a little extra time, if you haven't, to no, not 3 p.m. Lunch is 1 hour, and a little bit. So let's break until let's say 2:10, just to give you a little extra time to work on the self-test. Okay, maybe 2:15. That seems reasonable. But I will now. One thing to keep in mind: I will be closing the room and reopening it so that we have a fresh session for the afternoon, so that because we're recording as well, people listening to this at home, we're only going to want to see things related to Chapter 3. All right, so come back at 2:15. For those of you at home, we will be have a work on those. In our next recorded session, I will be reviewing the answers for the chapter review problems for 3-1, 3-2 at the beginning of the Chapter 4 recording. Not to worry. Okay. All right. On that note, these are the things. Guys, you're running way too quickly. All right. So from today's class, then, we've learned how to calculate the CPP and EI contribution that people need to make, and how to handle overpayments if applicable. And we've talked about various employment-related tax credits, the Canada Employment amount, the emergency volunteer amount, and how to claim a refund of the eligible educator school supply tax credit. All right. Now, let's take a break until 2. All right. Thanks, everybody. And Charles, we can stop the recording there.
Okay, I shall stop the recording, and then I'll make you the host as well. Okay, stopping recording.